Morning students. Today we will discuss about the topic problem of deficit demand and excess demand. In the previous lecture we had studied about deficit demand and excess demand, and today we are going to discuss about the measures to correct deficit demand and excess demand. Deficit demand and excess demand can be corrected with the help of fiscal policy and monetary policy. Economic stability requires that the situation of excess demand and deficit demand are corrected as fast as possible because it is not good for our economic stability. Now the question arises, who does it? Government and central bank. Two authorities, government and central bank, also known as RBI, Reserve Bank of India, can correct these situation. Government can correct these situation with the help of fiscal policy, and the another name of fiscal policy is revenue and expenditure policy of the government. And RBI can correct these situations with the help of monetary policy. Monetary policy, you studied about monetary policy in the chapter 6, banking. Now, what is the meaning of fiscal policy? It refers to budgetary policy of the government to correct the imbalance in the economic stability of the economy. That means excess demand and deficit demand. And we will discuss about this policy in detail in the next chapter, government budget. Now, what are the components of fiscal policy and the way these are used? The components of fiscal policy are government expenditure, taxes, public borrowings, and borrowings from RBI. First of all, government expenditure. Government expenditure includes expenditure on public work programs such as construction of roads, dams, etc. Expenditure on various subsidies to the producer with the view to encourage production. Expenditure on education and public welfare programs. Expenditure on the defense of the country and the maintenance of law and order. Means here we are discussing where the areas where government spend their money, which government collects from us through taxes or other sources, and what are the components of expenditure on public work program, expenditure on subsidies, expenditure on education and public health programs, expenditure on the defense of country for the maintenance of law and order. By changing all the types of expenditure, government can correct the situation of excess demand and deficit demand. When there is excess demand, government can reduce the expenditure, and when there is deficit demand, government can increase the expenditure. In case of excess demand, when government reduce its expenditure, then the excess demand can be corrected, and when government expenditure is increased, then the situation of deficit demand can be corrected. The second component of fiscal policy is taxes. Taxes are the compulsory payment made to the government by the households, and we can use the component taxes to combat the situation of excess demand and deficit demand. By increasing the tax burden, the government reduces the disposable income of the households. When tax burden will be increased on the households, their disposable income will decrease. Accordingly, they will spend less money. Then AD will reduce and situation of excess demand can be managed. And by lowering the tax burden on the household, government increase the disposable income of the households. Accordingly, AD will raise and deficit demand can be managed. Third component is public borrowing, means borrowing by the government from public. And situation of deficit demand in case of public borrowing is managed by government reduces its borrowings from public. Then the liquidity with the public is increased and there will be more expenditure in the economy by the households. AD remains high and deficit demand can be corrected. Listen one thing. In case of deficit demand, we have to increase the demand. In case of excess demand, we have to decrease the demand. So government will work accordingly. In situation of excess demand can be corrected when government steps up public borrowing by offering attractive rate of interest. This reduces liquidity with the public. Automatically AD reduces and excess demand can be managed. When government offered high rate of interest to the public, then public will give more funds to the government. Then liquidity of the public will reduce and they will spend less, and AD will reduce accordingly. Excess demand can be managed. Next point is borrowing from RBI. When government borrow from RBI, it's another element of fiscal policy. It is increased to fight deflationary gap. When there is deficit demand, borrowing from RBI can be increased. As higher borrowing release greater liquidity in the economy. When government has more money, it borrows more money from RBI, then government has more liquidity, and then government release more liquidity in the economy to correct the deficit demand. In case of inflationary gap or in case of excess demand, borrowing from RBI is reduced. When borrowings is reduced, the amount of liquidity in the economy also reduces, and it is useful to correct inflationary gap or excess demand. With this, fiscal policy is completed. Now the next topic is monetary policy. Monetary policies adopted by RBI to correct the situation of excess demand and deficit demand. It refers to the policy which correct excess demand and deficit demand by regulating the cost of credit and availability of credit in the economy. Cost of credit and availability of credit. Components of monetary policy are and the way these are used. First of all, bank rate or repo rate. These all components you studied in the chapter 6 banking. Bank rate is the rate at which central bank gives loan to the commercial bank. It is a rate at which central bank gives loan to the commercial bank. In case of excess demand, bank rate is increased by the RBI. Market rate of interest is raised by the commercial banks. Cost of credit rises. It lowers the demand of credit and low AD and as desired to curb excess demand. Listen, when RBI will rise the commercial banks will get loan at high rate of interest, then automatically they will charge high rate of interest from the public. Automatically cost of credit rises and public will demand less loans from the commercial banks. Then liquidity will be less, there will be low AD, and this is desired to curb the excess demand. In case of deficit demand, bank rate is decreased by the RBI. Automatically market rate of interest reduced, cost of credit reduced, it rises the demand for credit, the AD will be high, and it is desired to correct the situation of deficit demand. Next we have reverse repo rate. It is the rate at which accepts deposit from the commercial bank. It is the rate at which RBI accepts the deposits from the commercial bank. In case of excess demand, reverse repo rate will be high. It induces commercial banks to deposit their surplus funds with RBI. There will be less credit creation, availability of credit will get low, less AD, and excess demand is corrected. Listen, reverse repo rate is the rate at which RBI accepts deposits from the commercial banks. RBI accepts deposits from the commercial bank. If commercial banks have some surplus money, then they can deposit with the RBI, and RBI will pay interest to the commercial banks. If reverse repo rate will be high, then commercial bank will deposit more money in the with the RBI. Then they will supply money to the public, less money to the public. There will be less credit creation. Availability of credit will low AD, and excess demand can be corrected. In case of deficient demand, the situation is reversed. Reverse repo rate will be low, and it does not induce commercial banks to park their funds with RBI. There will be more credit creation, more availability of credit, more AD, and deficit demand can be corrected. Next point, open market operation. It refers to the sale and purchase of securities in the open market by the RBI on behalf of government. RBI on behalf of the government purchases and sells securities in the open market. And this tool is also used to correct the situation of excess demand and deficit demand. In case of excess demand, RBI will sell the securities, and RBI soaks liquidity from the market, less reserves with the commercial bank, less credit creation, less AD, and excess demand can be curbed. Listen, sale of securities. If RBI sell the securities at low rate, then public will be attracted to purchase these securities for getting profits in the future. Then RBI can soak the liquidity from market. People will have less money to expenditure or to spend money in the market. Then there will be less cash reserves with the commercial bank, less credit creation, less AD, and excess demand can be corrected with this tool. In case of deficit demand, the situation is reverse. Purchase of securities by the RBI. RBI releases liquidity. Rise in the cash reserves with the commercial banks. More credit creation, more AD, and deficit demand can be corrected. In case of deficit demand, RBI will purchase the securities at higher rate. Automatically, the money is released by the RBI in the market, and people will get more money, more liquidity. Then there will be more cash reserves in the commercial bank, more credit creation, more the level of AD, and deficit demand can be corrected. Next point is cash reserve ratio. See, in short, we can say CRR. It refers to the minimum percentage of banks total deposit required to kept with the RBI. It is fixed by the RBI and is varied from time to time to regulate the supply of money. Actually, CRR, it's fixed by RBI as a minimum percentage to be kept by the commercial bank with the RBI. Means commercial bank has to deposit a fixed percentage of their total deposits with RBI, and that percentage is known as CRR. In case of excess demand, CRR will be high. In case of excess demand, CRR will be high, and in case of deficit demand, CRR will be low. If CR will be high, then low credit creation. If commercial bank will deposit more money with the RBI as a fixed percentage, then they will have less money with them. Then they can create less credit creation capacity with the commercial banks. Then availability of credit will be less, low AD, and excess demand can be corrected. In case of deficit demand, CRR will be lowered. Then there will be more credit creation, more availability of credit, high AD, and deficit demand can be corrected. After that, statutory liquidity ratio SLR. Every bank has to require to maintain a fixed percentage of its assets in the form of liquid assets called statutory liquidity ratio. The rate of SLR is fixed by the RBI and is varied from time to time. It's a percentage fixed by RBI to keep the reserve, a fixed percentage of their total deposits as a reserve with commercial bank itself. For example, total deposits of commercial banks are rupees 10,000. CRR is 3% and SLR is 4%. Then 3% of 10,000. 300 rupees is to be kept with commercial bank and 4% SLR 400 is to be kept with commercial bank itself. Then the 400 is SLR and 300 amount is CRR. In case of excess demand, as same in case of CRR, SLR will be high, then low availability of cash with commercial bank, low credit creation, low availability of credit, low AD, and excess demand can be corrected, and vice versa. In case of deficit demand, SLR will be low, then credit creation will be high, rise in the availability of credit, rise in AD, and deficit demand can be corrected. Next, we have margin requirement. I am explaining this with example. Suppose I want to take loan from bank, a sum of rupees 10 lakh. Then bank demand some mortgage or security, and bank is demanding security of rupees 15 lakh in return of rupees 10 lakh loan. Then margin requirement will be rupees 5 lakh, the amount of security minus the amount of loan. Now, definition, it refers to the difference between the current value of security offered for loan called collateral and the value of loan granted. In case of excess demand, rise in margin requirement. If there is more margin requirement, then bank will offer less loan in return of more securities. Then fall in the demand of credit, fall in money supply, AD is reduced and excess demand can be corrected. In case of deficit demand, margin requirement will be low. Then rise in the demand for credit, rise in money supply, then more AD and deficit demand can be corrected. Next point is moral suasion. It is like rendering an advice to the commercial bank by the RBI to follow its direction. It's like advice, foundation by the central bank over the commercial banks to follow the direction. Otherwise, the license can be cancelled by central bank. In case of excess demand, be selective and strict in lending, means less loans. Then fall in AD and excess demand can be corrected. In case of deficit demand, be liberal in lending. Then AD will be high and deficit demand can be corrected. The last point, rationing of credit. It refers to the fixation of credit quotas for different business activities. Like for agriculture, this amount, for industrial purpose, this amount, and so on. Quotas can be fixed. In case of excess demand, introduction of credit rationing, then less credit creation by the commercial banks, less money supply, and excess demand can be corrected. In case of deficit demand, withdrawal of credit rationing, there will be no quotas, more credit creation by commercial banks, rise in money supply, and deficit demand can be controlled. Thank you.